Morgan Stanley has put out a report that argues for a trading range for gold and actually is a little bit more bearish in bias than the title would say. ETF demand coming out of the West is key to a continued rally, and we agree with that. China demand, we've noticed, is resilient and may actually be captive, which implies insurance business, and we like that.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning, everyone. I'm Vince Lanci. This is the Gold Fix Market Rundown, being recorded at 7:30 a.m. Morgan Stanley calls the top for now. That's our main topic, referring to gold. And second, we do a little bit of a post-mortem or an update on China demand, because that is key to keeping this market stable on the downside. And the early signs are that things are good. So we'll touch base on that for a little bit. We're still developing it. All right, so here we go. Those are the two topics. And there's our homepage. Love that picture. I'm going to leave it there until it cracks the China demand. U.S. 10 years are down 2, yield 445 and change. The dollar is 101.56, down 21. S&P 500 is 58.30, down 18. The VIX is 18.59, up 21. Just look at the financials there. Everything there is a minor unwind of what happened yesterday. So it's a retracement, it's a correction, it's profit taking, whatever you want to call it. It's a counter to what happened yesterday. Gold, same thing, 32.55, up 21 and change. Silver, 32.99, up 40. Was up a lot more, but good sign when the gold-silver ratio comes in a rallying market, in a selling-off market. That's an alert for just to stay away, right? So this is healthy. Okay, copper, 462, up 5 cents, consistent with silver. That makes sense. WTI, 62.56, up 45, another 45. Natural gas, 357, 358, offered down 3.5. Bitcoin, 103 spot 500, up 800. Palladium, 950, up 260. Platinum, 992, up 18. Interesting. I wonder if the palladium sell-off relative to platinum has to do with some sort of Russian thing. Gold, silver, 98.64, maybe cracking. Really maybe cracking. I think there's a lot of gold, silver that needs to be unwound. Soybeans, 10.56, down 3.5 cents. Corn, 4.36 and change, offered down 3. Wheat, 5.10, spot 10, down 7. Wheat getting bludgeoned. All right. Where were we? Here we are. All right. Today's analysis, Morgan Stanley argues for a trading range. The title of their report is Gold, Risk On, Risk Off. It's a good report. Lots of charts that are basically industry updates. Probably what's most interesting is their path prediction from where to from here type of thing. Anyway, the report is basically, this is our notes here, after touching 3,500 an ounce intraday in late April, a $500 per ounce rise in about 9 business days, Morgan Stanley notes gold has settled into a range which they expect to hold for now. The key takeaways from that report are: 1, uncertainty on tariffs and global growth supported gold prices via investment demand, with very strong ETF flows through Q1 and most of April. 2, but high prices are starting to hurt gold demand elsewhere, with jewelry demand falling and central bank purchases slowing. And 3, for gold to keep moving higher, investment demand and uncertainty need to stay high as gold faces competition from other asset classes. Everything they're saying there is true. So let's go through these one at a time. Uncertainty on tariffs and global growth supported gold prices via investment demand. Right. Risk off, buy gold. American ETFs were buying that as they were getting out of stocks. But now they're getting back into stocks. And if it moves with a stronger dollar, they're going to sell some off. So the point is valid. But high prices are starting to hurt gold demand elsewhere, with jewelry demand falling and central bank purchases slowing. All right, we're going to push back on that. Um, they see things we don't, mind you. But high prices are starting to hurt gold demand elsewhere, with jewelry demand falling. That is a direct comment on China, and we've seen that in other places. Jewelry demand is falling because the price is high, but ETF demand in China has exploded by 4 times. So as the Chinese investor at the margin thinks about buying some jewelry or buying an ETF, he buys the ETF now. Now, it's not really a fair comparison, but the reality of it is the growing, burgeoning middle class in China buys gold, and they buy it in jewelry form for one reason, because they have a historical mistrust of the government. Um, but as that fades away, they're going to buy ETFs. All I'm saying is that the jewelry demand is definitely being hurt by the high price, but it's being cannibalized by the ETF demand. So it's really not that big a deal. I mean, who's talking about jewelry demand when central banks are buying like shit tons of gold every day? The jewelry demand is just whatever. They're not going to sell it. Maybe they are. Central bank purchases are slowing. Now, there's a big divergence here between, say, Goldman Sachs and other banks. And I would suspect that Morgan Stanley is probably the bank that keeps pushing uh, uh, back against Goldman Sachs's central bank demand is not going anywhere. And here's what I mean. Central bank demand after the election was perceived to be decreasing because the election's over, et cetera, et cetera. But then the tariffs kicked in, and central bank demand continued through that time frame. And then the tariffs kicked in, and central bank demand has surprised Goldman Sachs, and they adjusted higher. It has surprised Bank of America, and then I wouldn't know they surprised them, but it has surprised. Bank of America took note of it enough to look at how much gold would be bought by central banks over a time frame to neutralize their risk. So when you say central bank purchases are slowing, uh, if you are saying that the urgency of the buying has decreased somewhat, I could not disagree with you. If, however, you're saying that they're slowing down to not buy over the long run, I would disagree, simply because the world is, to various speeds, de-dollarizing. And the de-dollarization means your central bank reserves need to be diversified, right? And so that means, for example, Bank of America says 30% is optimal for the central bank reserves, and they're like 20%, depending on who you're looking at. And Goldman says, hey, you know what? China and the other central banks are buying more than we thought they would. So they start to slowly uprank. Anyway, I'm not saying this is a stale opinion, but I am saying it's a divergence between some banks and other banks. And I would not be surprised if some banks are long and other banks are short. 3, for gold to keep moving higher, investment demand and uncertainty need to stay high. Yeah, that's right. That's right. As gold faces competition from other asset classes, right? As gold faces competition, yeah, we know that. But that the yields are not a competition for the last 3 years. It really comes down to the physical demand. So investment demand and uncertainty underpins your ETF purchases. Okay. So what has driven gold this last, say, $500 has been the anchor supporting it of, say, China insurance demand and the ETF risk-off purchases. So with the speculative funds selling all the rallies, and the bullion banks buying all the rallies. So this is a valid statement. And I want to put a fine point on this. For gold to keep moving higher, meaning for momentum to stay in place, they're saying that ETF demand has to keep coming in. And we would just go back and when ETF demand was just turning a corner, we had said when gold was trading 3,000 a little over a month ago, we said if ETF demand gets back to what it was in 22, you're going to see gold trade between 3,600 and 4,200. So gold went as high as 3,500 with the ETF demand nowhere near where it was, back in 22. So our theory, our thesis, our idea is completely intact and probably somewhat conservative. That said, ETF demand has to continue for this to happen. So their point is valid. So what's the caption for this picture here? Gold ETFs has seen outflows and the S&P 500 has rebounded, suggesting gold is facing competition from other asset classes. Yes, as long as you're not talking about bonds, I agree with you. Moving on. Well, we have that full report. It continues in premium at bottom. We like it. Market recap. Wall Street ended higher and Treasury yields rose as the U.S. and China agreed on a 90-day tariff relief. A surge in the dollar tempered gold prices, while oil climbed on hopes of increased demand. Canada's main stock index ended higher as the United States and China reached a deal to reduce tariffs, boosting investor optimism and easing fears of an all-out trade war disrupting global markets. Okay. Has uncertainty decreased? Yes, because we have a 90-day ceasefire. 90-day ceasefire is an opportunity for cooler heads to talk. Or has uncertainty just been kicked down the road? Do you think China is going to capitulate? And they are under a lot of economic stress right now. There can be no doubt about that. I think the answer to that is uncertainty has decreased because people are willing to talk, and it has been kicked down the road. So in 90 days, if this isn't resolved, the investment demand is going to come back. Not necessarily from the ETF people, probably from the specs, though. So every day that goes by between now and 90 days is like a little bit of an increment. No resolution, no resolution. So probably about 45 days in, you want to reassess. All right. We say that in context of the behavior that we're seeing about China. So we'll get to that, the China update when we get to the charts. Related post, deep dive Goldman's options trades, breaking China-U.S. trade progress report. CPI prep, we just sent that out. That'll probably be out by the time you see this, and the mini pod trade talk holding pattern. The premium report, gold risk off. Topics discussed in that report, physical demand is strong, but mixed trends. ETF inflows, key to watch from here. Investment drives demand, competition from other asset classes becomes a bigger threat. How is gold demand evolving? That's a nice little section there. Where to next? And central banks slowing. Again, their perspective, and they have been, although they did call for 3,500 recently, they have been the laggard in calling higher prices, at least publicly. Let's go to the charts before we wrap this up. Because let's do a part 2 of yesterday, right? So here's the daily, and there's our ledge. China is still buying. So on one hand, according to me and things that I read, China's economy is definitely struggling. Look at the compromises. You've got the Boeing deal, the fact that they came to the table talking, and a host of other things. The data, right? Those things would argue that their deflationary problems are weighing on them, and the fact that they can't sell anything to us and can't get a reasonable substitute buyer, since they're not selling to themselves yet, argues that they would be less likely to buy gold. It just does, right? And yet the buying is there for now, which means that's captive buying, which means Goldman's right when they say it's the insurance buying and a sovereign entity, whoever that may be in Asia. So things look okay. And as time goes on, over the next 90 days, if this range holds, that lower line and to that middle line that I have there, well, you're going to start seeing this ratchet higher. Now, am I being bullish? No, I'm not. I'm just saying the ledge has held the first time down. And that argues for the buying to be, what's the word I used earlier today? Resilient, when I was talking to someone. It's resilient, it's captive. And so you have China's economy that is struggling, and you have China still buying gold. One of these two doesn't make sense, right? If China's economy is struggling, then they would back off on deflationary spending, meaning buying gold, and they would buy that with stocks. And I would say this, they're doing both. They're buying gold and they're selling treasuries. They're not ignoring their deflation risk, excuse me, hiccups, but they are de-dollarizing. De-dollarization is not an option. Undoing de-dollarization is not an option when you're in negotiation with someone. So when this cracks, if this cracks, then you can make the case that they really might be capitulating. So now to just be a little bit bearish on it. When the market was, again, this is stuff that I'm interested in, so sorry, you guys have to deal with it. This was the ledge. This was the buying by people front running the buying, and this is the buying. Okay? Now, the front running rallies off of it. Look at these wicks. Rallies, 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 rallies. Cracks. This is where your Nomura types start selling it, right? Finds the real buying, explodes. That's macro discretionary getting stopped out. And now, for whatever reason, again, there's that mystery seller up there. We don't know who that is. The market traverses the whole range in 4 days. It's fantastic. 2 days up, 4 days down, the whole range. Here we are at the previous explosion level, and we're up 17 to $20. If the market doesn't really run today after CPI, I don't really know that it will. I'd be less inclined to think that the market's going to traverse this range again, meaning it's losing its impulsiveness. So we could have one of these lower. Anyway, what did I say? If we crack this line, we go to here. Well, I don't think we've meaningfully cracked it yet. So to wrap it up, to add a little bit more about the China demand, the Shanghai exchange is 40% of the open interest now. Now, if you're arguing that gold is toppy, then you must be arguing that the Shanghai open interest is going to drop. If you're arguing that gold is not toppy, then you're arguing that the U.S. open interest is going to increase. So on the one hand, you have Morgan Stanley, which is saying toppy, which is implying that Shanghai will sell. And on the other hand, you have Goldman Sachs, which is saying not toppy, buy the dip because U.S. will buy. So that's it right now. It's a regional war. Will China sell or will U.S. buy? And you have to factor in all the calculus behind that. And if you look at the last 5 years, China may sell, but China is also buying. China's specs may sell, but China is also buying. All right, I want to belabor this too much more. In summary, Morgan Stanley has put out a report that argues for a trading range for gold and actually is a little bit more bearish in bias than the title would say. ETF demand coming out of the West is key to a continued rally, and we agree with that. China demand, we've noticed, is resilient and may actually be captive, which implies insurance business. And we like that. And we'll talk more about all this stuff later on. Have a great day. I'm Vince.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.